We have, a pension fund industry that is probably, I'm not sure there's any better group of pension funds in the world than Canadian funds. We have a REIT industry that has been extremely well managed and conservatively managed. We have a lending industry that for the most part is displaying pretty good rigor in their underwriting and good discipline in their underwriting. We have a development industry that is not being reckless in terms of new supply coming to market, certainly not compared to what we would have seen in the late 80s. And when you take all those things together, and then when you consider that the investable universe in Canada is pretty small, there's not that many good assets to buy. And when you further consider the amount of capital that's chasing those assets, the combination of those three things makes for a foundation in Canada that is just remarkably solid. And if rates are going up in response to improved economic activity, that's a pretty good thing. Improved economic activity, whether it's Canada or globally, means better job growth, better wage growth, better rental rate growth, better growth in cash flow. Those are all big benefits for the real estate industry. They may not fully mitigate the impact of an interest rate spike, but they have to be considered because they're very legitimate. We track the spread between cap rates and internal rates of return over 10-year Canada bond yields. The spread today is wider than it was at the last peak of the market in 2007. And that implies to me that there's a bit of a cushion already being built in there in anticipation of rates invariably going up. Every smaller topical issue that we talk about today, whether it's the condo market and how it continues to soar, whether it's the new office building wave that's coming to Toronto, all of those smaller topical conversations are all just subplots of this larger narrative, which is the trend of intensification. The way we look at location, I think, has to be continually sort of recalibrated, reassessed. Because of the fact that we are no longer sprawling out, we are growing up. Locations that we would have traditionally thought of as being B or C quality are actually perhaps A quality. Proximity to transit hubs today is more important than it's ever been before. Proximity to employment centers is more important than it's ever been before. When we're looking at shopping centers within the City of Toronto as an example, as an appraiser, that used to be a fairly simple exercise of taking a look at the cash flow and capping it. When we look at shopping centers today, we're doing almost a full land or highest and best use analysis on it. We're looking at development patterns in the area. We're looking at existing transportation access. We're looking at where future public transportation is being built. We're looking at opportunities to intensify those malls, to reposition them, to build condo, to build seniors. It's an entirely different process from what we would have done just 3 or 4 years ago.